In 2023, the U.S. saw a surge in entrepreneurial activity, with over 5 million new businesses registered, a record high. While data for 2024 hasn't been released yet, experts anticipate the numbers could break new ground again. At the same time, investors seem eager to pour billions into startups that barely have an idea, especially if they mention artificial intelligence. Yet, there's an underlying problem that often goes unnoticed. There are fewer companies than ever before. Back in 1996, U.S. stock markets hosted over 8,000 publicly listed companies. Nearly 3 decades later, even though the economy is now 3 times bigger and trading volumes are 7 times higher, the number of listed companies has dropped to less than half. Many theories attempt to explain this trend. Private equity growth, corporate mergers, and shrinking participation from everyday investors are among the most discussed. But the reality may be more complex. Iconic brands like Toys R Us, Purdue Pharma, and Bed Bath & Beyond have all declared bankruptcy. Some tech companies go public too early, while others are swallowed by market giants. This is a time to learn money in all ways. If you wish to learn more money-making ways, make sure you subscribe to my channel. On this channel, we share different money insights based on world circumstances and offer different opportunities. Now let's continue the videos. A small group of massive companies now dominates the stock market. Microsoft, Nvidia, Apple, Amazon, Meta, Alphabet, and Tesla make up over a third of the S&P 500's market capitalization. If you include Berkshire Hathaway, Broadcom, and Walmart, these 10 companies represent over half the market, up from just 16% in 2015. This extreme concentration isn't good for investors, workers, consumers, or even the companies themselves. One major driver behind this shift is private equity. These firms manage assets outside public stock exchanges and have grown significantly, by more than 1,200% in the US alone since 2000. Companies often prefer private funding to avoid the burdens of public compliance and the pressures of thousands of shareholders. Most individual investors don't directly own stocks anymore. Instead, they invest through retirement accounts, which often allocate money to private equity funds. Going public doesn't offer the same advantages it once did, unless the company is already enormous. Even when private equity firms want to cash out, they often sell their assets to larger private firms rather than through IPOs. As a result, private equity-backed companies now outnumber public ones by a wide margin. If they had all gone public, the landscape would look very different. But even returning to 1990s levels wouldn't be enough. The economy has grown so much that we should have about 25,000 public companies, yet fewer than 4,000 remain. Ownership is also becoming more concentrated. Major shareholders of nearly every big public company are the same handful of asset management firms, namely BlackRock, State Street, and Vanguard. These companies don't technically own the assets themselves. They manage them on behalf of millions of investors through index funds. These funds make it easy for average people to get broad market exposure, but they also consolidate power in the hands of just a few institutions. This consolidation affects market competition. For example, Vanguard holds major stakes in all 4 major U.S. airlines: Delta, United, Southwest, and American. These companies dominate domestic air travel, but instead of competing aggressively, they tend to avoid price wars. Because their top investors don't benefit when one company wins at the expense of another, they also own. As a result, companies raise prices, cut services, and add fees, actions that benefit shareholders more when everyone plays nice rather than fights for dominance. Ironically, this strategy can hurt long-term shareholder returns too. Some monopolies seem good at first. Take Netflix. When it dominated streaming, it offered great service at a low price. But when other media giants jumped in with their own platforms, consumers needed multiple subscriptions to access the same content. What was once a cheap alternative to cable became just as expensive and far more fragmented. This pattern is common when new technologies emerge. Initially, many businesses try to enter the market, but only a few survive. Historically, monopolies like the Dutch and British East India Companies were necessary for global trade. Today, the difference is that big companies expand into new markets with in-house funding rather than letting startups grow independently. Netflix was the only major streaming service not already part of a big studio or tech firm. Now, most new ideas are absorbed by existing giants. Amazon is a prime example. It can offer same-day delivery and cloud services thanks to massive infrastructure investments. Competing with them would require hundreds of billions of dollars, so most retailers just sell through Amazon instead. Companies like Toys R Us couldn't keep up. Social media works the same way. Users gravitate toward the biggest platforms. Meta's apps dominate because everyone is already there. Whether you're posting memes about aging on Facebook or job hunting on LinkedIn, you go where the crowd is. Antitrust enforcement is weak. Even if regulators act, companies continue to consolidate because their investors often overlap. A single large firm tends to outperform two smaller competing ones, making mergers financially appealing. Bigger companies have more resources to grow and invest. If they can't build something, they'll just buy it. Private equity and asset managers accelerate this process, but another force discouraging competition is venture capital. Though venture capital is supposed to fund innovative startups, it often aims to create companies that are quickly acquired, especially by tech giants. Studies show this focus stifles innovation, since startups are designed for exit strategies, not sustainable value. If a startup dares to compete with an existing tech service, investors back off due to the risk. This creates kill zones, areas where innovation dies because dominant companies can outlast competitors financially. Even worse, this system hasn't helped investors either. The finance industry has grown to absorb more wealth through fees, commissions, and incentives. Its share of GDP has jumped from 3.5% in the 1970s to over 10% today. Institutions now hold assets worth over 180% of US GDP, up from less than 50% in 1980. These firms aren't too big to fail, they're too embedded to regulate effectively. The last major breakup by the FTC was in 1984 with AT&T. Since then, the only penalty for monopolistic behavior has been fines, which many companies treat as just another business expense. In the end, more and more economic activity is being absorbed by financial intermediaries, rather than flowing to businesses or individuals. If your takeaway is that finance professionals are soaking up too much of the economy, you wouldn't be wrong. And make sure you subscribe to learn money always.